Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'll be your host today. And I just could not be more excited about our guest today. We've got Brian Burke with us today. Yes, the Brian Burke, President and CEO of Praxis Capital. Brian and the team has over $800 million worth of real estate, 4,000 multifamily units, and over 700 single-family units. He's also subdivided land, built homes, done construction of self-storage, and very excitingly, he is the author of a book that gets recommended here all the time, The Hands-Off Investor. So, Brian, welcome to the show. We're so excited to have you here.
Randy, I'm really excited to be here. Thanks for having me.
Absolutely. Absolutely. And I'm going to get this out there right away. I mentioned that your book gets referenced. I will ask for a book or a podcast suggestion at the end on every podcast, and probably 50 times your book has been suggested. And I started this trend, I don't know, call it 6 months ago, when anybody would suggest the book, I'd say, anybody that reaches out, I'll send them a copy of it. And I'm just going to throw it out. If anybody wants to email me their address at randy@impactequity.net, I will send you a copy of the #1 book on passive investing, so you can start your education journey. So, Brian, that was a little bit of a commercial, and a lot more commercial than I normally do on this, but really excited to have you here. But can you tell us a little bit more about yourself and how you got to become the #1 suggested book on this podcast and a huge syndicator?
I can, but first let me say something about you. You're a very generous man to be giving that book away to anybody that asks, because even I don't get them for free. So that's really cool for listeners that are hearing that offer. Boy, take them up on it. I don't know how much they charge for that book, but it's like 20 or 30 bucks or 40. I don't even know what it is, but that's really, really generous of you. I started investing in real estate 35 years ago, and I started out in single family, and then, I don't know, 25 or something years ago, ventured off into multifamily and kind of never really looked back. Been buying multifamily ever since. You mentioned about 800 million in real estate. That's what I've acquired in my career. Thank God I don't own all that stuff anymore. I mean, yeah. I started aggressively selling in 2021 and was done selling by middle of 2022, which, as it turns out now, if we look back, that was the exact peak of the market. So thankfully, I got out of most of what I own. I still have about 1,000 units now, but in this career, I've raised over 350 million from passive investors for our acquisitions. And I feel like I'm just getting started, although I'm on a break because there's just really no viable thesis for investing today. So I'm on the sidelines waiting and watching for the right moment.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Well, I love it. I think probably if you could package up that crystal ball that you used to figure out to sell the 21 and 22, that would probably be more valuable than the assets you own today, I suspect. But
yeah, you're probably right.
I'm curious. What did you see happening that led you to dump all this property back in 21 and 22? Everybody else was pretty excited at the time, but you made the decision to sell. So talk about that if you can.
Well, that's exactly why, because everybody was so excited. And, you know, when you have something that everybody really, really wants, don't deny them the opportunity to have it. When there's that much enthusiasm about real estate, that's about when you know you've reached a market top. I mean, everything was 110%, right? You had
Yeah.
high rent growth, low interest rates, massive transaction velocity, all kinds of buyers in the market. Everybody's a syndicator. Everybody's raising money. Everybody's investing passively without even doing a lot of homework. When all of that stuff happens all at the same time, it's just not a recipe for a good outcome. It's like a four-way intersection where all the lights are green. Eventually, everybody's going to collide in the middle of the intersection. So we might as well just, get off the highway, so to speak, let all that happen, and then get back in there and sweep up all the glass.
I love it. Yeah. So it's, I know at the time you probably got a lot of slack from your peers for selling everything and not buying more. What was your response to them? Was it simple as what you just shared with us, or did you even get a lot of people giving you a hard time? I'm curious.
Oh, I got a lot of people giving me a hard time when we were buying our stuff. We were buying in 2013, 14, 15, 16. People were like, "Oh, prices have gone up so much. How can you possibly make money?" And then it's the same people that were saying that were enthusiastically buying in 2021, by the way. I guess they finally just threw the towel and said, if you can't beat them, join them. I got a lot of grief in 2009 when we started aggressively buying foreclosed single families in the San Francisco Bay Area. But nobody was giving me a hard time 5 years later when we sold them for 2.5 times what we paid for them. I've built a career around kind of like doing what other people aren't doing. And I'm used to it. So whatever it was they were saying, I couldn't even tell you because I wasn't listening.
Yeah. But I'm curious then, what's, the saying, be fearful when other people are greedy and greedy when other people are fearful. What are you using to understand economic trends? Where do you get your information from that you're basing your decisions on if you're not listening to the masses?
Well, I get information from a variety of sources, some paid, some free. So I get a lot of different news every day. I probably spend an hour to an hour and a half every day reading industry news and, what's going on in the markets and that sort of stuff. I also have, access to data from the like CoStar and Axiometrics, that sort of thing. That helps to get some raw data. I look at Census Bureau data and population movement, but it was none of that data that prompted me to start selling. It was all about what people were willing to pay and the way they were willing to do it. When you put up a property for sale and you get 24 offers for way more than you think you should get, with non-refundable earnest money deposits in the 6 or 7 figures upon contract signing, you just realize that the market's really, really hot. Yeah. And that's usually a good time to start retreating. So it wasn't even so much about saying, "Oh, I got data from this and this indicator said that." It's just looking at the psychological behavior behind the market. Another good kind of opposite example was, 2005 in the single family side. I'd go to real estate club meetings and people would be like, "Oh, I've got to buy a rental house," and it's like, okay, they're $500,000 and they rent for $1,500 a month. And this is in Northern California where I'm at.
Sure.
I'm like, tell me what about those numbers make any sense? And of course, the person saying it has zero experience in real estate. And it's just like, this is not going to end well. So that's when I basically got out of the single family market for a while. And then it started to fall. It fell down. And in 2008, I picked it back up and started buying again when people were like, "Oh, real estate's like catching a falling knife and real estate's toxic. You can't invest in real estate." It's like, I'm glad you think that, because that means it's time for me to get in.
Yeah. And it's exactly the time to get up off the bench and start buying. So I'm curious there's a lot of folks having similar conversations today, saying the sky is falling. There's going to be blood in the streets. Actually, they've been saying this for a year now, probably. Is there certain things that you're watching that once they occur, it will tell you it's time to get back into the game?
Yeah. So you mentioned the Buffett quote, to be greedy when others are fearful. And there's a lot of people that are saying like, okay, well, right now people are fearful. So this must be the time, right? I don't agree. I think over the last, call it year and a half, maybe 2 years, buyers became fearful. It's like, well, I can't buy because interest rates are too high, or rent growth is falling, cap rates are still too low, whatever the excuse. Buyers were fearful. And so some people would interpret that to say like, this is the meaning of the phrase. It's now time to buy because people are fearful. But the problem is that it's the wrong people who are fearful. It doesn't matter if buyers are fearful. When sellers become fearful, that's when you've reached a market bottom. And sellers will become fearful when they're wondering how they're going to make the next payment. They're afraid that they're going to run out of cash. Their loan is due and the lender won't extend and they're pushed up against a wall. Their investors are revolting because they haven't gotten distributions and things aren't going well, and the sponsor isn't communicating with the investors and all of that kind of stuff. When sellers get into that position and then they realize, well, I'm not going to get a V-shaped recovery on rent growth, or I'm not going to get immediate relief from high interest rates, because a year ago everybody said, rates are going to come down 4 times in 2024. Well, it's June 2024 as we're recording this. How many times have rates come down? 0.
Right.
How many times are they going to come down? No one knows. Maybe 1 is what the Fed is saying. When? No one knows. But as this is happening with these higher interest rates, a lot of these sellers are burning through all their cash and they're running out. And for some of them, they won't be able to rebuild those reserves, and they're going to have no choice but to sell. And when sellers have to really put their product out to market in any sort of volume, right now there's been little onesie twosie on and off deals, but when there's any amount of properties being released to the market, the price of those assets is going to have to meet the market, and price discovery is going to take place. And I think when true price discovery starts to take place, we're going to find peak to trough movement in prices somewhere in the 40% range. That's a deeper trough than the 2008 great financial collapse. And, that's going to signal more of a market bottom when those things happen. When the sellers get fearful, then that's going to be a real time to jump in. Now, it may never happen. We could get to this place where, interest rates do begin to fall. A lot of sponsors are able to kind of pick themselves up and carry on. And, maybe there won't be any number of transactions that's really going to occur. And we're going to kind of slowly crawl our way back out of this. And it'll be a really long kind of L-shaped recovery. That's entirely possible that will happen. But the longer that these higher for longer interest rates persist, the more pressure there's going to be on a certain subset of sellers, at least. And that's going to lead to some opportunity.
Okay. So what I keep hearing over and over is that lenders are working with the borrowers on, extend and pretend. I hear that over and over and over again. At some point, the lenders won't be able to do that. And you're suggesting we could see an additional 20% loss in value or an additional 40% loss in value of where we're at today?
I think we're already 40% under. It's just under peak pricing from, call it mid 2022. I think we're 40% under that pricing level. And it probably troughs out somewhere around here. But the problem is that you still get deals that are transacting 20% below peak pricing because there's very few sellers and there's still buyers that really kind of have to transact. They've got a 1031 or they raised a bunch of money and they have to allocate it or they look foolish. Whatever the scenario is, there's always going to be at least a small number of transactions that are going to take place. And when you have transaction volume this low, you don't really expose what the pricing is because you have motivated buyers. When you run out of motivated buyers, then true price discovery takes place. And I think that's when the true price decline will be exposed. And I think it's going to expose out somewhere in that 40% range.
Okay. Now, you mentioned an L-shaped recovery. I've not heard that term before. Can you talk through that a little bit?
Yeah, that's where, it's funny how real estate works is prices slowly climb, but when they fall, it's like a light switch goes off. They instantly drop. And that's the way it kind of works. And so like a U-shaped recovery would be where not too long after the prices drop, they start to climb their way back up. A V-shaped recovery would be like almost as soon as you hit the bottom, you go right back up. That's what happened during COVID, right? COVID was a great example of that, where transaction velocity dove off a cliff the second that they did all the lockdowns. But 3 months later, it was back to business as usual. In fact, the market was stronger than it was before COVID. An L-shaped recovery is one where, if you look at kind of like 1990 to 1997, that was a 7-year period where pricing almost didn't move at all. And this is why you'll notice, like, have you ever noticed that there's not a lot of 1990s built apartments? There's a lot of stuff built in the 80s. And there's a lot of stuff built in the 2000s, but there's hardly anything built in the 1990s. It's a very small section of the apartment stock. And that's because pricing just wasn't moving back then. There's really no incentive for people to build because it wasn't going to be worth any more after you built it. So, pricing just kind of went along in a straight line. They didn't really go up or didn't really go down for an extended period of time. And I think we could see that happen here, which is why I'm not in a big hurry to say, oh, we got to start buying, or we have to buy exactly at the bottom, or we're going to miss the movement and it's going to just outrun us and, run back up and we're going to miss the whole thing. I think we can just sit back and wait. I'm looking for solid evidence that the market is out of the unwinding phase and back into, the growth phase before I feel a need to get back in.
And it's interesting though. I think like from your vantage point, you've been in the space for, 35 years, something like that.
That's right.
Not quite 35 years, about 35 years.
Yeah, 35.
You had your opportunity where you built this huge portfolio, you got to sell it off. You're kind of sitting in a position where you don't have to buy assets, right? You've got 1,000 units right now. You can focus on really improving those, driving NOI up and returns to your investors and make sure you can exit those correctly. But there's always going to be a constant flow of new people coming to the space. And, it's been my argument that there's always deals that can be done. If, the terms look right, if the property is in the right market, if you've got a skilled operator, all of these different variables that come into play, I feel like there can always be deals that are getting done. Would you disagree with that?
No, there's a needle in every haystack. And okay. I've made a lot of money in, kind of inopportune moments by finding an opportune set of circumstances. Now, they are needles in haystacks and they're harder to find. And, new people have a lot of time on their hands because this is like they're dedicating their 100% of their focus to finding these needles in haystacks. And they're energetic and they're like, I'm going to take risks and I'm going to make phone calls and I'm going to do all this stuff. Yep. And some of them will find those needles in haystacks and a lot of them will fail and go back to doing whatever W-2 job they did before they got into the business of chasing down real estate deals. But those few that manage to find something and get lucky enough to find that needle in haystack could happen at any moment.
Thank you. I appreciate that. And it's to your point, though, it is truly the needle. And there's got to be a ton of activity in order to find the needle. So one of the things I've seen that seems to be working with folks is this tax abatement strategy. Do you have any thoughts or opinions about those models?
Not necessarily. I think if you specialize in those kinds of things, more power to you. So I'm more of, I used to be a real needle in the haystack guy. I always looked for the arbitrage play, for the weird, aspect of a deal that I could unweird and, make it more profitable. Now I've been in this business longer and, now I'm more of a buy the haystack and forget about the needle. So, for that model, I'm in the canoe coasting downstream and I just need to steer. And it's just a better place for me to be in this phase of my career. Now, earlier in my career, I was paddling upstream like a mad dog. And you're fighting the current and there's rocks coming at you and there's probably some alligators in the water. And that's okay. That's okay. It takes that energy and that enthusiasm to find those things and make it work. Now, having said that, those can be a lot higher risk. And a lot of those deals fail because they thought it was really a needle in a haystack when really it was like a turd in the haystack. There's a lot of things that can go wrong, especially from newer investors that don't really know what they're looking at or what they're looking for. To them, everything looks like candy in a candy store, and they're the biggest kid with an appetite. So we've all been there, and that's okay. But not all of those deals are going to work out right.
Yeah, no, and thank you for this. It's a different perspective. We talked about this before you came on, where you've been on the other side, saying that now is probably not the time to be buying. So for a guy like me who's out there working with investors and placing capital, it's not common for somebody like me to ask you on the show, but I think it's important to get this other perspective so we truly know what we're walking into. And the reality is there's a lot of people today that are losing money in this space, from a passive investor standpoint and from an operator standpoint. And, I'm curious if you've got advice for folks, like if people are sitting in positions where they're getting capital calls, or they've got paused distributions, or God forbid, their operators aren't returning their calls and they've not gotten distributions. Like, what do you suggest to those folks right now?
Yeah, that's an interesting question, and one that's has rarely been asked as I've been guests on podcasts over the last several years since podcasting became a thing. Sure. But this topic is going to become more and more relevant. You're one of the first people to ask me about this because people didn't want to talk about it.
Sure.
But it's really going to become an increasing issue, I think, and so. The first thing you have to figure out is, what's going on with your investment. Did you invest in something that was an outright fraud or scam from the get-go? You need to figure that out. And chances are the answer is more likely to be no than yes. So hopefully people are at least reassured by that it's more likely that it did not begin as a scam. But you still have to investigate that and rule it out. Assuming that you weren't just flat out scammed, then the next thing you got to do is figure out what's going on with the asset. And really, if you invested with a good sponsor that's just caught in a tough situation because the market isn't cooperating with them, finding out what's going wrong shouldn't be that difficult. It should be a matter of just opening up your most recent quarterly report and reading what they've told you. Because if they really are good, they should be telling you, this is what's happening, this is how we're being attacked, and this is what we're doing to defend ourselves. If they're not saying any of that stuff, that's a problem. And it's time for a conversation. Now, first, if you aren't getting any kind of communication from them at all, I would say rule out whether or not there's some kind of technical issue, right? Do they have the wrong email address for you? Is your email sending all their inbounds into your spam folder? Check in there. Sure. Is your email service blocking emails from them? And I mention this because as an investment sponsor, we communicate with our investors a lot. And oftentimes we'll get a call from somebody going like, I haven't heard from you guys in 6 months. And it's like, really? Are you not getting the emails we've been sending you? And then they go like, oh, well, then we find out, Gmail blocks all the mails coming from this investor portal. And, there's a technical issue. So rule out whether or not there's just a technical communication issue first.
And you know what, Brian, it's so interesting you say that. So I had a potential investor that everything was showing unsubscribed in our CRM. And when I ended up having a conversation with the investor and asked, I understand that you unsubscribed. Was it because I'm sending too much or whatever was that? And he's like, no, I absolutely did not unsubscribe. And in fact, I've been wondering why I haven't been seeing anything from you. So some of these tools are going to misrecord unsubscription. They're going to go into spam, just exactly like Brian said. And if you want to hear from your operators or from folks you're working with, don't be afraid to pick up the phone or shoot them an email as well, because these types of things happen all the time.
That's exactly right. Pick up the phone, send them an email. If they have an investor portal, log into the investor portal, because oftentimes the investor portal will keep a history of the emails that have been sent to you, and you might find that there's email in there that you didn't see. Your quarterly reports might be stored in there, and there might be information. So check your investor portal. Now, assuming all of that fails and, you've got nothing in the investor portal, they're not responding to your emails, they're not picking up the phone and calling you, that's when you might realize you've really got a problem. And I've heard of this happening, by the way, quite often. And usually the way this kind of works out is somebody invests with a newer sponsor that doesn't really know what they're doing or hasn't been doing this for long enough to really kind of know all the ins and outs. And the deal starts going sour and they don't know what to do. They don't know how to fix the problem because they don't have experience with adverse market cycles and all this other stuff. Maybe they didn't structure the investment right from the outset, so it was really difficult to recover because they're in an unrecoverable position. And, in as much as they don't really know what to do, they also don't really know what to say. So they bury their head in the sand and just kind of hope the problem will go away. Well, it doesn't. I mean, you've got 100 investors that put up $50,000 or $100,000 with you. They're not going to just vanish into the woodwork and you're not going to hear from them. I mean, you're going to have to face the music.
Right.
So, but you'd be surprised how, oftentimes that's kind of the first line of defense for people is to just kind of clam up and go hide. Yeah. So you got to track them down. And if they're still not responding to you after all of that, then you could try contacting an attorney and having the attorney send a demand letter to, require them to produce documents and financials and that sort of thing. You can go to another step of contacting your state's Department of Corporations or Securities Department. You can go to federal securities regulators, the Securities and Exchange Commission, file a complaint. If you're concerned that there's outright financial fraud, you can contact the FBI's Financial Fraud Crimes Division. If you think that there's actual criminal activity that's taken place, and that's rare in the world of real estate sponsors, but it does happen. There are people that will steal the money, and it's why I think The Hands-Off Investor is a 250-page book with about 150 pages of why you really need to be careful about who you invest with to try to eliminate having this problem. But once you're in, it's too late. They're either gonna be good or not, and you can't go back and say, "Oh, I should have never invested with them." That's not going to help you.
Yeah. So I'm curious. You mentioned a number of different paths that can be avenues for investors to pursue. I would imagine that finding an attorney in this space might not be that difficult. It might only cost a couple $100 to have them draft a letter like that. So these are really resources that are available to anybody who is participating in the space and has concerns, that's gone through the steps that you've already listed about reaching out and trying to get to them and logging into the portals. So there really are avenues for people to get the answers that they're looking for. The answers might not be what they're looking for, but they can find those answers out, I think, relatively easily. So I'm curious with your experience, and obviously 4,000 doors, 1,000 currently, were there times with those assets where you had to pause distributions as well, and then you were able to come back around and turn the distributions back on? Or once you see a pause distribution, is that really just kind of bad news and it's not likely going to come back?
No, it's absolutely happened to me, and it's happened to anyone. And I'd say that if anybody ever says that, oh, they've never had to pause distributions, or they've never had, this or that happen, they just haven't been doing it long enough, or haven't done enough, or they're just kind of running a Ponzi scheme anyway, or they're just distributing back investor principal that they raised at the outset. There's actually more than you would think sponsors that do that, where they raise extra cash and then they make distributions out of the extra cash they raised, which is really just giving people back their own money, but it looks to the investor like they're getting a distribution. So they think, well, everything's okay. Well, no, really, they're just burning through cash, and it's kind of the same as a Ponzi scheme. So it's very dependent upon the circumstances, right? So when you're investing in a syndication, you're making a real estate investment. And make no mistake about it, you're just hiring someone else to administer that investment on your behalf.
Yeah.
So just like any other real estate investment can run into trouble, syndications can do the same thing. And it's not necessarily indicative of misconduct by the sponsor or even incompetence by the sponsor. It could be that the market's moving against you. And if you own this property 100% yourself, you would be running into the same problem. And you might not, you wouldn't call it a capital call, but you might have a shortage of making the mortgage payment where you're writing a check out of your bank account to cover your expenses. And if anybody's ever owned a rental house and the rent didn't quite cover the mortgage, or the water heater blew up and there, you had to write a check out of your own account to get a new water heater, welcome to the world of real estate ownership. And the same thing happens with syndications. Now, you would like to think the syndicators raised a lot of money up front to be able to handle those kinds of issues, and they maintain capital reserves for unplanned things. But sometimes these unplanned things can be a lot more than anybody bargained for. Like, say, for example, what if the index on your loan went up 5,000x? Like, in other words, like, your index was, SOFR 2 years ago at 0.05, and now it's 5.3. So, when that happens and it stays there for a year and a half, that wasn't on anybody's radar. So that's going to create an issue. Now, I've had cases where we've had to pause distributions and then later we're able to restart them. I've had cases where we've paused distributions until the asset eventually sold and we've made a lot of money at the end and actually produced a really good return. I had a syndication where I had to actually make the mortgage payment out of my own pocket because I didn't want to capital call my investors. Sure. I did that for 3 years before we finally had enough cash flow out of the investment to come back. And when we did finally sell the investment, there was enough out of the sale to pay myself back all the money I loaned in and pay the investors all their money back plus a return. And right now we've got paused distributions because of interest rates. But it's not a death sentence. The death sentence really depends on other factors, and that is how is the capital stack structured? What's your loan to value ratio, or at least what was it when you took the loan out? When does the loan mature? That's probably, I would say, the most important one is when does the loan mature? Because those are the things that come back to really create problems. Like if you've got paused distributions and you've got a loan that's due in 6 months, you're in really big trouble, especially if that loan was a high loan to value ratio and there was a minimal amount of equity that was raised. So let's say you bought a $100 million real estate portfolio and you raised $10 million to do it. That's like a really thin capital stack. I mean, you get like a 10% movement in price and you're completely wiped out. And, I've said that prices have moved out a lot further than 10%. So that's a real issue. And then, if the sponsor has to capital call the investors to salvage the deal, the capital call could be 100% or 200% of your initial investment, just to give enough cash to have a cushion, let alone try to refinance the property into a lower loan to value ratio loan, which could require them to raise 5 times the amount of cash they originally raised at the beginning. Now, contrast that to like the deals that we have where we're paused right now. Our loan to value ratio is like 60%. We had a lot of cash. And if we have to capital call, we'd capital call a very small percentage of what the investors originally contributed. And that would generate enough cash to get us by for years. And we have no loan maturities for 9 years, I think, or 8 years. So we don't have to worry about any of that stuff. So just by the fact that distributions are paused doesn't mean that I've lost all my money or the investment is a complete failure. Does it mean that you're not going to get your projected return? More than likely, that would be the case. And that would happen regardless of whether you bought that real estate directly or whether you're invested in a syndication. So you really have to look at the totality of the circumstances to decide what that really means.
I love it. Well, I literally, as we keep talking, I keep writing down more and more questions, but I keep watching the clock here as well. I feel like I could do 4 more episodes with you with just the questions I have, but I certainly want to be respectful of your time and for the listeners' time. So if you do have just a couple of more minutes, I do have a few questions that I like to ask everybody before we wrap up, though.
Let's do it. And you can always ask me back.
I would love that. So, well, let's get through these and we'll definitely discuss that. So, we've already talked at length about this book, and we've already shared that I'm going to send that to anybody that shoots me an email with their address. But outside of your own book, what would you say is probably the best way for new or newer passive investors to get educated in this space?
Oh, wow. Great question. I think join a club that has other people that invest in passive real estate investments so that you can learn from their experiences and from what they've seen and from the deals that they're looking at, and have a dialogue back and forth. And there's a number of different online communities that that circle around in that space. So I'd recommend that.
Are there, and not calling you out on this, but are there any specific ones that you think are good, or maybe not even that you're putting your stamp on, but ones that you know of that people could investigate?
I know that a lot of our investors are members in a group called the 506 group, and another one called Left Field Investors. Those are 2 that I'm aware of that have been around a while.
Yeah, I know them real well. Jim and the team at Left Field are fantastic. And I was a member of 506B until I became a capital allocator and capital raiser, which
then they kicked you out.
Then they kicked me out, which I understand. They don't want people around their pitching stuff, which I think is important. It's got to be a safe place. And LFI did something similar as well, to where they started to categorize folks. But yeah, no, I think that's the best thing. One of our advice to investors is always, always, always invest with people that you have been referred to by, third parties that don't have any skin in the game at all. It really is the best way to find operators. So, okay, so I've got a few kind of fun questions here. One is, do you have a recent bucket list item that you've checked off your list, or one you're hoping to in the near future?
Well, we finally went to Europe last year, which was at least on my wife's bucket list, which was actually really fun. We got to tour a lot of stuff in London and Paris, and so that was a great time. We haven't been really world travelers because for the last 35 years I've been working 100 miles an hour with my hair on fire, and now that I don't have very much to do, we're able to go out and have a little fun. So it's been a lot of fun.
I love it. Yeah, you got to be bored out of your mind with just 1,000 units, I'm sure, right?
Yeah, it pretty much is. It's kind of a non-event.
That's funny. That is so funny. Other people would die to be sitting on 1,000 units. All right. So if you had $100,000 you had to place this week and you couldn't put it into one of your own deals, where would you put that $100,000?
Well, I can't put it into my own deals because we don't have any deals. I'm not buying anything what did you say, in the next 90 days or something like that? Sure, is that what you said? Sure. Yeah. Well, yeah, I won't have anything in 90 days. I'm pretty sure of that, or even a lot longer. I've been investing in a variety of different things as a passive investor, as an LP passive investor, in oil and gas partnerships. I've invested in a couple of pharmaceutical startups, new drugs. What else? An agricultural company. So just a broad spectrum of other asset classes that are outside of real estate. Okay. And I do invest in a couple real estate deals here and there when I see something I like, which isn't all that often these days.
Sure. No, it's a good perspective. I've looked at oil and gas. I've not found anybody that I felt comfortable putting money with. And actually, I had one guy I was about to invest with, and he got indicted by the FBI. So I was like, I'm done.
That's not
I'm
good.
not going any further. Yeah.
Yeah, that's not good. That's a good red flag to avoid. Good thing you diverted off of that. Yeah, that's definitely a no-go. Sure.
Sure. Question number one on the due diligence: is the FBI in your front yard right now? Right?
Yes, exactly. That's right.
All right. And then kind of a final one that I just started asking. I have like this, it's a little over the top, but I've got like 100-point checklist that I go through when I'm vetting deals. So I'm curious, what's your number one due diligence question that you ask when you're looking at alternative investments?
Well, it's really about the sponsor's experience. It all comes down to that for me. If they've been doing it a long time and have been through adverse cycles and survived those adverse cycles, that's kind of the number one thing. Because if they've been doing it for a long time, they must be doing something right.
Yeah.
The people that have been doing it for 2 years, it's like, well, you're lucky so far, maybe.
Yeah.
But you don't get lucky for, decades. Things will happen, and how you navigate that and how you survive it is going to define the rest of your career. So I want to see somebody that's survived a market cycle and didn't come out of the other side completely bleeding.
Yeah. Yeah. I started my due diligence journey with how many full cycle deals and how many deals have you done? And that has evolved much more beyond, a 5 or 10 year calendar for sure. So
anybody
really
that did a full cycle that bought in 2014 and sold in 2019, did just fine. So you got to look at the context of that track record. That makes a big difference.
Yeah, absolutely. Well, Brian, thank you so much. First, I was shocked when you said you'd be on the podcast. So thank you so much for being on the podcast. This has been a true honor. I really appreciate it. This has been a lot of fun.
Yeah, it's been my pleasure to be here. Thanks for asking me.
Awesome, Brian. All right. And to the audience, as always, thank you for listening today. We encourage you to continue your education journey. I usually say that both the guest and myself suggest that you start investing right away. But I'll just say continue the education journey. I suggest that you do make the decision to start investing passively. And Brian says start investing passively when the numbers make sense. So again, thank you guys all for joining us again today. And join us again next Thursday for another great episode. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.